Hello everyone. Welcome to my Workbook Solutions videos for Managerial Accounting. This video covers Chapter 20, CVP Analysis. Please note that if you are watching this video at a much later date than it was posted, the chapter number may have changed as well as the page number of each example in your workbook. Overall, that shouldn't matter as the example problems we'll work through will still help explain the material. I'll also show the question in its entirety within the presentation, so you won't actually need a physical copy of the workbook, though having one will make the process much easier for you. Without further ado, let us proceed. Let's start on page 1 of the Chapter 20 section. The power costs of Jones Manufacturing behave as a mixed cost. The activity that creates most of the power cost is machine usage. Therefore, power cost will be analyzed in relation to machine hours. Machine hours and power cost for the past 6 months are presented below. In the left column, we have our months ranging from April through September. In the middle column, we have our machine hours for each month. In the right column, we have each month's respective power costs. Let's answer the following 4 questions based on the previously provided information. Starting with number 1, we'll identify the months with the highest and lowest power usage and cost. Which of these months has the highest power usage and cost? August. How about the lowest usage and cost? July. Our high is August with 20,000 hours and $2,200. The low is July with 14,000 hours and $1,900. Next, we'll calculate the difference in machine hours and power costs. Starting with machine hours, we have 20,000 hours in August and 14,000 hours in July. The difference is 6,000 hours. Now we'll do the same for power cost. Before we proceed, it's important that we calculate this difference in the same order that we did for machine hours. In other words, for the machine hours difference, we calculated it by subtracting the low amount from the high amount. 20,000 minus 14,000. When we calculate the power cost difference, we have to subtract the low amount from the high amount as well. We could calculate these numbers by subtracting the high from the low, but we would have to be consistent using the same order for both calculations. Otherwise, the monetary amounts we're about to determine will be off. The high power cost is $2,200 for August. The low power cost is $1,900 for July. The power cost difference comes to $300. Now we move on to number 3 and compute the variable cost. We use the figures in number 2 to do so. We're trying to get a rate of dollars per hour, so we divide the $300 cost difference by the 6,000 hour time difference. Our variable cost rate is 5 cents per hour. Finally, we can now solve for the fixed portion of our total costs. I'll demonstrate the solution first using the lowest machine hours, then the highest machine hours. Either way will yield the same solution. The formula for total cost is variable cost per unit multiplied by the number of units plus fixed costs. Our total cost using the lowest hours was $1,900. Our variable cost per unit is 5 cents per hour. The rate will be multiplied by the corresponding number of units for the month, or in this case, 14,000 hours. Now we just simplify the equation and solve for fixed cost. Multiply the 5 cents per hour times 14,000 hours, and the equation becomes $1,900 equals $700 plus fixed cost. Use some algebra to solve for fixed cost, which equals $1,900 minus $700, or $1,200. The process using the highest machine hours is identical, and it will yield the same result. The total costs in the high month are $2,200. The rest of the formula will be the same, except we will plug in the hours for August, not July. This equation simplifies to $2,200 equals $1,000 plus fixed costs. Solve it for fixed costs, and that variable equals $2,200 less $1,000, or $1,200. You can see how fixed cost is the same under either method, so we can have confidence in our numbers. Flip over one page to page 2. Let's do some calculations. Sales and cost data for the Van Buren Company are as follows. Note that this data is based on the sale of 20,000 units. You see the table in the middle of the page showing the total and per unit revenue and costs. Let's determine Van Buren's following items: total contribution margin, contribution margin ratio, unit contribution margin, increase in net income from a $50,000 sales increase, and increase in net income from a 1,000 unit sales increase. Starting with number 1, how do we determine the total contribution margin? Total contribution margin is based upon sales and variable costs. Take the difference between the two, and the result is total contribution margin. Number 2, calculate the contribution margin ratio. The contribution margin ratio is the contribution margin expressed as a percentage of sales. The general formula for this ratio is sales less variable costs divided by sales. With the information provided in this table, we can calculate the contribution margin ratio in a couple of ways. The first is based upon our total sales and variable costs. Take the difference between those two numbers Then divide by sales. The result is 32%. You can also calculate this ratio using the per unit data. Take the difference between the sales price per unit and the variable cost per unit, then divide by the unit sales price. Again, the result is 32%. If you have both the total and per unit data provided, you can do it both ways to check your work. Since we got the same percentage both times, we can be confident in our work. Number 3, calculate the unit contribution margin for the company. You could almost probably guess what this calculation is. If the total contribution margin was based on total data, then the unit contribution margin is based on the per unit data. Simply take the difference between the sales price per unit and the variable cost per unit. The unit contribution margin comes out to $9.12 per unit. Number 4, calculate the increase in net income that would result from a $50,000 increase in sales. The formula for determining the net income from a given sales increase is the sales increase in dollars multiplied by the contribution margin ratio. In this scenario, we would take the $50,000 sales increase and multiply it by 32%. This is the amount we calculated in point number 2. Net income would increase by $16,000. You can understand the previous formula by using dimensional analysis. The contribution margin ratio is sales less variable costs divided by sales. Think about what the contribution margin is. It represents the money from our sales we can put towards increasing net income once fixed costs are covered. In other words, it represents for every dollar of sales, how much money will be added to net income. If we multiply this conversion rate by the proposed sales increase, the product is how much money will be added to net income. Applying this method to our given information, our conversion rate is 32 cents added to net income for every dollar of sales. Multiply that by the $50,000 proposed sales increase, and you get $16,000 added to net income. If you want to verify your work, you can always build a contribution margin income statement. This statement takes the following format: sales less variable costs equals contribution margin. Subtract fixed costs from contribution margin to get net income. Using our provided monetary amounts, sales is $570,000. Subtract variable costs of $387,600 to get a contribution margin of $182,400. You'll note that this number ties to our computation in number 1. Subtract fixed costs of $140,000, and net income is $42,400. How would these figures change if sales were increased by $50,000 to $620,000? Before we go any further, we need to figure out how many more units we sold if we're going to figure out the changes of the rest of these items. If sales revenue goes up by $50,000 and each unit is sold for $28.50, units sold increased by 1,754.39 units. A company cannot really make 39% of a sale, but that's the way the problem was written, so let's just go with it. Note that the data in the table is based upon a sale of 20,000 units. This means the total units sold would be 21,754.39 units. If you multiply this new total sales by the sales price per unit, the total sales revenue reconciles to that $620,000, rounded of course. Variable costs would increase to $421,600. The total units sold multiplied by the variable cost per unit of $19.38. The new contribution margin would be $198,400. Those units multiplied by our unit contribution margin. Fixed costs of $140,000 will not change because they are fixed. The new net income will be $58,400, $16,000 greater than the original amount of $42,400. This dollar increase reconciles with the increase calculated from the formula. Number 5. Calculate the increase in net income from a 1,000 unit increase in sales. You can calculate this amount by multiplying the unit sales increase by the unit contribution margin. Using our given amounts, 1,000 units times $9.12 per unit, the unit CM we calculated in number 3, net income will increase by $9,120. As I showed you previously, you can understand this formula using dimensional analysis. This unit CM means that $9.12 is added to net income for every individual unit sold. Multiply the conversion rate by the proposed additional 1,000 units sold, and $9,120 will be added to net income. You can further verify this results with a contribution margin income statement. Recall that the numbers you see before you are based upon an initial sales amount of 20,000 units. If we increase total sales by 1,000, we've sold 21,000 units. Multiply those new sales by the sales price per unit, and total sales revenue will be $589,500. Updated variable costs will be $406,980. The new contribution margin, $191,520. Fixed costs will still be $140,000. The new net income will be $51,520, a $9,120 increase over the original amount. Turn over to page 3. Abner Corporation makes a product that sells for $200 per unit. The variable costs to make this product are $120 per unit. Fixed costs total $500,000 for a year. Abner currently sells 7,500 units. If you're feeling confident, pause this video and try to perform the following 4 calculations. Starting with number 1. Calculate the number of units Abner must sell to break even. The formula for a company's break-even point is fixed costs divided by unit contribution margin. Abner's annual fixed cost is $500,000. Unit contribution margin is the difference between the unit sales price and its variable cost per unit. For Abner, it will be $200 less $120, or $80 per unit. Divide these numbers, and the resulting quotient is a break-even point of 6,250 units. If you're wondering why we divide, imagine the bar on this chart represents a company's fixed costs. Every time we make a sale, we bring in revenue. If we make enough revenue, we have covered our fixed costs. However, not all the revenue can go towards satisfying fixed costs. We must reduce it by each unit's variable cost. In other words, the amount of revenue that can go towards covering fixed costs is the unit contribution margin. The quantity of sales where the unit contribution margin is the same as our fixed costs is the break-even point. Number 2. Calculate the number of units that Abner must sell to make $200,000 in profit. We can modify our previous formula for break-even point to determine the amount. Specifically, fixed costs plus target profit divided by unit contribution margin. Our fixed costs are still $500,000. Add to that amount the target profit of $200,000, and our numerator is $700,000. Unit contribution margin is unchanged at $80 per unit. The necessary sales to generate 200 grand, 8,750 units. Going back to the previous chart, the target profit effectively increases the amount of fixed costs we need our contribution margin to equal. Number 3. Abner can purchase equipment that will automate its production facility. This equipment will raise Abner's fixed cost to $600,000 per year. Automation will cause the product's variable cost to drop to $100 per unit. How many units will Abner need to sell to make $200,000 profit if the factory is automated? We're still using fixed costs plus target profit divided by unit contribution margin, just with some revised figures. Fixed costs are now $600,000, not the original 500 grand, though target profit is still $200,000. Plug those amounts into our numerator and it will be $800,000. The unit contribution margin will change. The sales price is $200 per unit, but the variable cost per unit has dropped to $100 per unit. The difference in our denominator will be $100 per unit. Our sales required to make 200 grand in profit in this scenario, 8,000 units. Last one, number 4. Abner estimates that $40,000 of radio advertising could increase the company's sales by 10%. Should the company purchase the radio ads? Use the original cost data to answer this question. Do not include any changes due to factory automation. We can solve this problem using a contribution margin income statement. First, we'll figure out the total sales revenue. Abner's current sales volume is 7,500 units, and the unit sales price is $600 per unit. Total sales revenue will therefore be $1.5 million. To get variable costs, we multiply our sales volume by the per unit variable cost of $120 per unit, or $900,000. The total contribution margin will be $600,000. Abner's default fixed costs are $500,000, leaving a net income of $100,000. Now we determine the revised amounts under this new scenario. Abner was originally selling 7,500 units, but advertising may increase this amount by 10%. So multiply 7,500 units by 1.10, and the updated sales volume is 8. This new sales volume multiplied by $200 per unit gives us a total sales revenue of $1,650,000. Variable costs will also be impacted by the additional sales. Multiply 8,250 units by $120 per unit, and we have $990,000. The updated contribution margin is $660,000. Fixed costs will also increase by the $40,000 of advertising, giving us $540,000. The new net income is $120,000. So Abner would do well to invest in radio advertising if this projected sales increase is accurate. Turn in your workbook to page 5 to consider the following information for Trimble Company, which sells an electronic toy for $40. The variable cost is $24 per unit, and the fixed cost is $32,000 per year. Management is considering the following changes. Alternative 1. Trimble will lease a new packaging machine for $4,000 per year, which will reduce its variable cost by $1 per unit. Alternative 2. Trimble will increase its selling price 10% to counteract an expected 25% increase in fixed costs. Alternative 3. Trimble will reduce fixed costs by 25% by moving to a new location. This would have the effect of increasing variable costs by 10%. Consider and answer each of the following questions independently. In other words, each of the following 5 scenarios are independent of one another. Round calculations to the nearest unit. This is another problem in which I'd recommend pausing this video and trying to do as much of it as you can on your own. Letter A. Determine the current break-even point in units and in dollars. Here, we're just using the information given in the problem without considering any of the 3 alternatives. Our formula for the break-even point is fixed costs divided by the unit contribution margin. Fixed costs are $32,000. The unit contribution margin is the difference between our unit sales price of $40 and the per unit variable cost of $24, or $16. This gives us a break-even point of $2,000 or units. Units. You can understand this fact by applying dimensional analysis. Our fixed costs are $32,000, so that's the amount of income we need to generate to break even. For every 1 unit sold, we receive a net of $16 after deducting the variable cost from the sales price. So the units we need to sell to get $32,000 of income is 2,000 units. To calculate the break-even point in dollars, we divide fixed costs by the contribution margin ratio. The fixed costs are still $32,000. The contribution margin ratio is the difference between the unit sales price and the variable cost divided by the sales price. So we will divide $32,000 by 40% to get a break-even point of $80,000. You can check this result in a number of ways. The obvious way is to take our break-even sales in units and multiply it by the sales price. The product is $80,000, which reconciles to our calculated amount. Yet another way is to use dimensional analysis. Again, we need to generate $32,000 of income to cover our fixed costs. For every $1 of revenue that we bring in, we get to keep 40 cents as income. So we need $80,000 of revenue. Lastly, you can verify them using a contribution margin income statement. It's important that you memorize its format, not just for answering questions when necessary, but also as a means of checking your work. Sales was $80,000. The sales price times 2,000 units. Variable costs are $48,000. $24 per unit times 2,000 units. The contribution margin is $32,000, which equals fixed costs of the same amount. Net income is therefore zero. Letter B. Determine the expected profit assuming alternative 1 and sales of 3,200 units. When we want to figure out a profit, let's make use of that contribution margin income statement again. Our sales price is $40. Multiply that price by the quantity of sales, and revenue is $128,000. The variable cost per unit is $24, but this new machine will reduce that cost by $1 per unit. So our total variable costs are $23 per unit times 3,200 units, or $73,600. The total contribution margin, $54,400. Trimble's base fixed costs are $32,000. But this new machine will increase that cost by $4,000. So revised fixed cost comes to $36,000. The expected profit under alternative 1, $18,400. Letter C. Determine the break-even point in units and in dollars assuming alternative number 2. To get the break-even point under alternative 2, begin with our formula for the break-even point. Our standard fixed costs of $32,000 are expected to increase by 25%, so multiply that number by 1.25. The revised fixed costs are $40,000. Unit contribution margin is the difference between the unit sales price and variable cost, but the sales price changes under this scenario. Specifically, it increases by 10% to $44 per unit. Subtract from that amount the $24 variable cost, and unit contribution margin equals $20 per unit. The break-even point, 2,000 units. The break-even point in dollars is the fixed cost divided by the contribution margin ratio, fixed cost still being $40,000. The contribution margin ratio is the unit contribution margin expressed as a percentage of the sales price, or 45.45%. The break-even point in sales dollars, $88,000. You can verify this amount by multiplying the break-even point in units by the revised sales price per unit, which is exactly $88,000. You can also verify the break-even point with the following contribution margin income statement. Letter D. Determine the break-even point required in units and dollars assuming alternative number 3. Starting with the break-even point in units, fixed costs are currently $32,000 a year. Under this scenario, they would be reduced by 25%. So multiply that 32 grand by 75%. The revised fixed cost figure, $24,000. To get the unit contribution margin, we start with the per unit sales price of $40 and subtract the new variable cost per unit. Alternative 3 reads that variable costs would increase by 10%. So multiply $24 by 1.10 to get $26.40. The unit contribution margin works out to $13.60 per unit, yielding a break-even point of 1,764.7 units. Calculate the break-even point in sales dollars by dividing $24,000 by 40 minus 2640 over 40 for a break-even point of $70,588.24. As in the previous example, multiply the break-even figure in units by the sales price to convert it into dollars. The decimals necessitate some rounding, but the two numbers approximately tie to each other. Once again, please refer to the following contribution margin income statement to verify the break-even point. Lastly, letter E. Determine the volume of sales required to earn $23,600 assuming alternative number 3. Piggybacking off our previous formula and the solution for the break-even point in units, if we want to know how many units we must sell to achieve a desired net income, just add that target profit to the fixed cost in the numerator. Our required sales volume will be 3,500 units. If you want to check this figure, build a contribution margin income statement. Sales revenue at 3,500 units sold will be $140,000. Subtract variable costs of $92,400 to get a total contribution margin of $47,600. Subtract the reduced fixed cost of $24,000 to get a net income of $23,600. Turn to page 7 and refer to the following sales mix problem. A gourmet food manufacturer has considered renting a booth at a local mall to sell gift boxes of candy, nuts, and cookies during the holiday season. The fixed cost to rent and operate the booth would be $27,900. The unit contribution margins and sales mix anticipated by the company are as follows. You can see in this table the unit contribution margin and proportional sales mix for each type of gift box. Let's figure out how much of each gift box we need to sell to break even. We'll start by calculating the contribution margin for the composite unit. The composite unit doesn't actually exist. It is a sort of hypothetical unit we create based upon the sales mix percentages, presuming those percentages will remain consistent from one year to the next. To figure out the composite unit contribution margin, we will multiply each gift box contribution margin by its respective sales mix percentage. We then sum those products to get a composite unit contribution margin of $1.55 per unit. Next, let's figure out the break-even point for the composite unit. We're still using the same formula to find the break-even point. Take the $27,900 of fixed costs and divide it by the contribution margin for the composite unit. Our break-even point is 18,000 units, or composite units to be more accurate. Finally, using the sales mix, calculate the number of each type of gift box that needs to be sold to break even. The problem with the break-even point of 18,000 composite units is that those units do not actually exist. Remember, they are hypothetical units created from our sales mix percentages. That aside, converting composite units into our actual inventory units is actually very easy. We'll merely multiply those 18,000 composite units by each gift box's percentage. To break even, we need to sell 9,000 gift boxes of candy, 5,400 gift boxes of snack nuts, and 3,600 boxes of cookies. Turn to page 8. RGF Manufacturing makes a product that currently sells for $20 each. The variable costs to make this product are $12 per unit. Fixed costs total to $800,000 per year. Take a moment and try to solve items 1 and 2 on your own. Number 1. How many units must be sold to break even? To find break-even points in units, start with fixed costs. Then divide by unit contribution margin. The difference between the per unit sales price and variable cost yields a unit contribution margin of $8 per unit, giving us a break-even point of 100,000 units. Number 2. What will be the company's sales revenue at the break-even point? Take the unchanged fixed costs and divide it by the contribution margin ratio, which is the unit contribution margin expressed as a percentage of sales. Or 40%. The necessary sales revenue to break even, $2 million. This amount reconciles mathematically to the product of the unit sales price and break-even units. You can also verify this number with a contribution margin income statement. Number 3. Assume that the company's current sales are $2.6 million, 130,000 units per year. Calculate the company's margin of safety in dollars, in units, and as a percentage. Starting with Part A. Margin of safety is calculated as the difference between sales and the break-even point. All it measures is how much revenue a company can lose before it no longer generates a profit. Calculating this item as a monetary amount, we take the given sales revenue of $2.6 million and subtract the break-even point of $2 million, and the margin of safety is $600,000. Margin of safety can also be calculated in units. The formula is the same one we just used, except for the denomination of the numbers. The given sales in units is 130,000. Our break-even point in units is 100,000, which we figured in part 1. The margin of safety in units is 30,000. Note that this amount reconciles to the margin of safety in dollars. We need only multiply these 30,000 units by their sales price. Now let's figure the margin of safety as a percentage. Expressing this computation as a percent should be intuitive. We merely divide the margin of safety we just calculated by the sales revenue amount. In this case, RGF could lose 23% of its sales before it generates a loss. You can also calculate this ratio using units. Either method will produce the same percentage. Lastly, turn to page 10. Calculate the operating leverage of a company with the following information. Operating leverage is the quotient of the contribution margin and pre-tax income. Divide $600,000 by $200,000 and you get an operating leverage of 3. Operating leverage indicates by how many times a company's pre-tax income will increase for every percent increase in revenue. For example, if sales increase by 5% for this company, its operating income will increase 15%. 5% multiplied by the operating leverage of 3. You can verify this fact by examining how much the contribution margin income would change under such a scenario. Sales would increase to $840,000. Variable costs would also increase by 5% because variable costs vary in proportion with how much we make and sell. I should probably clarify that in these examples, the company is manufacturing what it will sell without excess. The contribution margin is now $630,000. Fixed costs are unchanged at $400,000. The pre-tax income becomes $230,000, a 15% increase over the original amount. That concludes this video. There may be a couple of problems in the workbook I didn't cover. If so, you can find their solutions in the course module on Blackboard. I encourage you to try them on your own to test your retention of the material. Please let me know if you have any questions. Thank you for watching.